Let's move on to what is the cynosure of all eyes when it comes to the primary market, and that's the big bang Zomato IPO. Lots of opinions and lots of question marks being raised on the fact that it's still a loss-making company, that the valuations perhaps are looking too rich, or what is going to happen when the company eventually lists, what should investors as well be doing. Karan Taurani joins in from Elara Capital. He's taken out an interesting report on this, so let's find out what exactly the report says and how one should be looking at this IPO. Karan, let's just start off at the get-go by talking about, Zomato as a company, one of its kind really in the e-commerce place to have taken center stage. How are you looking at the fact that it's still a loss-making company and one is, attributing some very rich valuations to it? What do you make of that, and how does one value an e-commerce company, because it is by and large a new concept in India?
Right, thanks. So if you look at Zomato as a company, the company has been doing well, and the pandemic is something which has worked completely in favor of them because of delivery taking a sharp uptake and, dine-in coming down because of, restaurants being shut or open with restrictions. If you look at the numbers here in terms of what has happened to a Zomato on a 9-month basis, FY21 as per reported numbers, there's a massive turnaround, right? We've seen order values literally go up almost 40%. We've seen the contribution per order basis, coming positive. But my sense here is that most of these trends, are not sustainable in nature. So the reason for that is, the order value had actually gone up because people started ordering food from the premium restaurants. And once things come back to normalcy, I think people will again go back to dine-in and, pay for the entire experience as a whole, rather than calling food from premium restaurants. The second trend also what happened was, in terms of delivery charges. So delivery charges also, kind of went up almost 70-odd%. And that was to do with two things. One was, the dine-in people, the frequency had come down. And the second thing was the order value, which went up, which is there. The third very interesting point which happened is that for the profit to come in on a 9-month basis was, the discounting coming down. Now, discounting, as you see, is a very big variable for increased frequency. And discounting actually, came down from a 7 to 8% kind of a number, net AOV towards a 3 to 4% kind of a number. So that also kind of had a positive impact on profit. So I think some of these trends in terms of the AOV uptake, in terms of discounting, may not be sustainable in nature, because if you have to drive the frequency, you may have to start giving discounts. But if you look at a steady state and a structural story basis, I think Zomato is poised for a growth of almost 25 to 30-odd%. And that's driven by multiple structural factors. One is, of course, increased penetration in India in terms of smartphones, be it, Zomato entering into new markets and the tier 2 and tier 3 markets put together, increased frequency, which is there. So metro cities are already penetrated towards the 60-70% right now, but you could see increased frequency growing there. So these are like 3-4 massive growth drivers, which could actually do well for Zomato and probably go towards a 25-30% kind of rev growth. If you look at the valuations here, clearly, I think valuations will be basis 4 factors which are there. So generally, internet companies in India, if you look at Infowars, they trade at a very premium multiple. But that's because of the scale which they have. That's because of the market leadership which they have, and that's because of the profitability they make. Now, I think Zomato valuation will be based on 4 factors, I believe. So one, of course, is the kind of growth rates one is looking at. So growth rates of 25-30% is fair at a steady state for the next 5 years. So that is something which is working quite favorably for them. The second factor would be clearly in terms of the scarcity premium, and the scarcity premium.
We seem to have snapped that, but yeah, Karan just giving us a snapshot as to how the company is going to stack up in terms of valuations versus the global peers. As DoorDash, Grubhub, Uber Eats, Deliveroo, those are some of the prime companies overseas in the United States and the UK. And the Elara report seems to suggest that Zomato may trade at a premium valuation vis-a-vis some of its global peers, largely on account of better growth rates, and therefore it's likely to command a scarcity premium within the Indian internet space, although they have alluded to the fact that the profitability issues loom large. So Karan understood that point with respect to the scarcity premium that you're talking about. So you believe that it is likely to trade at a premium, a scarcity premium, compared to other players, even overseas within the same space like DoorDash, Grubhub, etc.?
So I think that's what I was coming to the point there. So overseas players, if you look at the numbers there, I think they are growing at similar growth rates as compared to what a Zomato would be. They are profitable companies. Zomato also is profitable, but this is just basis FY21 because COVID hit us. I think we have to see whether how the profitability sustains from here on going ahead on a steady state basis. And the third factor, of course, is market structure. So if you look at global market structure, I think those markets are quite consolidated or duopoly, triopoly kind of markets, or these are markets where 90% of the market is owned by the top two players. So similar is a market structure for India, which augurs well for Zomato as well. But with the third player coming in, this could kind of have a negative impact. So I think as of now, I think growth rates is something which is working favorably well for Zomato because we don't know of a third player. I mean, an Amazon who tried, food delivery and who's been testing waters in some cities, if they were to come in, there could be some market share grab up for them. For valuations, if you believe, I think if global players are at almost about 4 to 8 times EV sales basis, Zomato, given whatever the triggers are, whatever the market structure and whatever the concerns put together, should trade at almost about 10 to 12 times EV sales.
Okay, what are the kind of growth drivers for Zomato? What are those numbers looking like? Because with limited presence versus others in the global arena, it's still at the lower end, I guess, when it compared to some of its global peers. Do you see it catching up?
Yeah, so growth drivers, typically there are a couple of three major growth drivers actually to say. So one is, of course, the increased smartphone penetration, which will actually get more users onto your platform. The second growth driver actually is basically your penetration into tier 2 and tier 3 markets, wherein they have to really expand more and, increase the number of restaurant offering put together. And the third growth driver is increased frequency. So as I was telling you that, if you look at the metro cities, there the penetration in terms of online food delivery, I mean, these are industry numbers, but they are somewhere close to 60, 70%. So the only way to get growth in the top 10, top 8 cities would be increased frequency. So I think all these three things put together, you can easily see a growth of 20, 25%. And maybe another 5-7% of growth put together, on the some part on the AOV, some on delivery, which is inflation-led largely. So a 25-30% growth is what you're looking at.
Okay, that's the kind of growth then that you're looking at. Do you also see any significant shift to the business model in time to come? There's been a lot of talk about how some of these companies are still cash burning, and it hurts the books at least for the next couple of years, as well as they're on this growth trajectory that's likely to be the same. What do you think would reassure the markets on that front?
On the cash burn front, I think it really depends on the market structure. That's a very important thing. So if you look at the cash burn number, typically in the last 3 years, it's been phenomenally high, and that's primarily to do with the market structure as well. So, we saw Ola Foods, Uber Eats, Food Panda, and the likes of others entering the food delivery market, and who were giving steep discounting. And that actually led these aggregators also giving those kind of steep discounting. But I think given the current situation now where we are in, I think they have a market share of close to about 90-odd%. So unless you see a large player like an Amazon coming in, smaller players won't have too much of an impact. So in case we don't see a large scalable player entering the market, these companies can become profitable in the next 3 to 5 years.